In a previous episode, we talked about the power of compound interest and how we can think about our investments in a very particular way to, obviously maximize your investment. We talked about thinking about, retirement and putting our investments in a particular place and going, well, does it make sense for us to pull it out at this time or this time and this time? And we analyze different scenarios, and it made sense. The power of compound interest in time, over time, is very, very powerful. And we very clearly in that particular episode highlighted that case and helped make the case that we have to be realistic about when we think we're going to retire if we're going to rely on the power of compound interest to do the work for us, because we there are only three inputs into using compound interest as that vehicle. You've got your time, you've got your principal, and you've got an interest rate. You can only play with those three things to create, say, the outcome you're looking to create. And the reality is you really only get to control a couple of those things. And in this particular episode, what we're going to do is we're going to look at the idea of the rate of return. So in the last time we looked at time, this time we want to talk about the rate of return on the compound interest. And really it comes from, like, I think when people think, okay, part of my strategy for building wealth, and this is like the FIRE movement, the FIRE folks who are like, I'm going to invest heavily in, say, equities, maybe index funds. I'm going to start at an early age. I'm going to use the power of compound interest, but I'm going to now I'm going to think about the average rate of return on, say, the S&P 500 is like, I'm going to get 9% on average every year over the course of a lot of years. So it's like, I know that there's going to be some down years, and I know there's going to be some years that beat that, but on average, I'm going to assume the 9%. And people start to calculate based off this and predict based off this. Today, what we're going to look at is, like, how likely is that outcome? Can we rely on the 9%? Should we rely on that 9%? Because the time, even though, like, this phrase, Kyle, it's time in the market, not timing the market, but actually timing the market plays a huge factor.
Kind of matters. Yeah. And as you're going to see here today, it's like it makes a massive impact on what you might expect, right? Like this is the hardest part of this whole journey, is really the fact that most investments, especially growth investments, are very hard to predict. Now, we flip all the way to the other side and we look at, a lot of people are jealous of those defined pensions that are out there, right? So, you and I coming out of the education space at one point where, we were walking away from those golden handcuffs. Like, a lot of people assume the pension amount is actually a lot higher than what it really is, but it's the certainty, right? It's the fact that you don't have to guess.
Locked in.
As to what's going to happen. That's the part that people really gravitate towards, and knowing that there will always be money coming. But in reality, those pensions actually aren't providing you with this massive return like a lot of people are anticipating. So what we saw in the last episode, if you'll recall, we had looked at different ages. We were looking at a 40-year-old, and we were looking at, hey, if they were going to, contribute until age 64 and then retire at age 65, compared to age 55 or 54, and then all the way down to like a quicker early retirement, like going to age 49 and then retiring at 50. There were massive differences that we saw. Like, we saw investing for 24 years gave you a long enough time horizon where you could start with less. We had 100,000 as the example we were looking at, and contribute less, about 10,000, and giving a average rate of return of 10%. We're using like just the S&P 500. We're like, wow, like you could potentially start withdrawing about $183,000 in the age 65. So in year 25 of this plan. Now, again, that's assuming it's 10% every single year. And what we saw is that when we put in for less time and, when we put in lesser amounts, obviously it actually impacted that amount massively. Like when we went down to a 10-year timeline with someone who is compounding to age 49, from age 40 to 49, putting in 100,000 and 10,000 a year got them only $35,000 per year based on
Mhm.
that 10% compounding rate of return. And of course, we explored different asset allocations. We looked at, if you were 100% equity all the way down to like a 60-40 or a 50-50 with fixed income and equities, like that impacts the rate of return, but in like almost like a fictitious way, because
Mhm.
those aren't real rates of return. Those aren't real, what we call sequence of returns that you'll expect to receive in the markets. And therefore, the actual result can vary quite drastically. And that's really what we plan on looking at today. And we're actually going to use the S&P 500 and the actual historic rates of return. And we're going to take those and just start in various years so that we can explore very similar scenario here where we're going to contribute similar amounts of money until age 64 or until age
Okay.
54 or until age 49. And we're going to show what would happen if the market acted like it did from a certain time point in history, right? So whether it's like right before the Great Depression, or whether it was like during one of the up years, where it was like one of the best times to start investing. What if we start taking money out during a bad time in the market, right? And we get to see that dramatic differences in what you can actually achieve based on the actual sequence of returns. But here's the other part, is that we don't know if any of these sequences will happen in the exact same way ever again either, right? So it introduces still
They won't.
a really, really, no, exactly. And it's going to introduce this variability, which means like, what do we do? And we're going to talk at the end of this episode of like, what are things we can do in
Mhm.
order to prepare ourselves? And we always like to talk about base cases, like to get yourself a base case where hopefully you get only better scenarios than maybe some of these worst case scenarios that we'll look at.
I like it. I like it because I think that floor helps prepare. Because I think what we often do is we think of average, and we think, and this is where most people are predicting from. It's like, what is the average rate of return? What do we get on average if we do this, which is the middle, And is it, yep, I'm going to go up from the average, down from the average, but on average, I will get this value. We like to look at the base case. We like to look at what is the minimum and how can I structure the minimum so that when I hit the minimum, I'm real happy. And then anything above the floor, anything above that minimum is like bonus, because then you're putting yourself in an amazing spot. Because if you plan for the average, you're going to all of a sudden you're never going to be on the average. Like if you think about data management and data analysis, the average is rarely a data point in the data set. The median is the middle value of a data set, and that is a value, often is a value in the data set. But if you plan for a minimum, if you plan for the base case, what you're going to say is like everything above that is gravy. Everything above that is bonus for us. And we're already happy with the minimum. So let's structure for the minimum. Let's plan for the minimum. And then we're going to be in a great shape if anything above the minimum happens.
That you said that beautifully. It's like, you, John, were going back to your high school math teacher days, and you were explaining that so clearly.
That, huh?
And really, though, it really has a massive impact on everything that we've done in our own financial planning, right? Like this is, for me, my primal question being like, am I financially secure? Like to a fault, is something that I want to almost have in my mind, almost like a base case that I know will only be better than that amount, right? Like, cause I'm like, I don't want to potentially put myself in a position where I go, oh shoot, that didn't work out. Too bad. Try again next life, right? Because guess what? We only have one of these things. So what we're going to explore today, we're not going to look at, different asset allocations today. We're going to assume all equities here today. Okay. We're going to assume all equities. Now you can consider this being 100% of your portfolio. If you're like someone from the podcast that we had had a conversation with recently that is in 100% equities, or it could just be the equity portion of your portfolio. Your fixed income is going to be significantly less. And here's the sad reality is a lot of times your fixed income, moves in similar ways during bad times as your equities. So it's actually not that protective. So we're going to look just at equities today. And you'll see up on the screen, we're going to use that $100,000 starting point, $10,000 a year. Again, not suggesting this is what you should do or, if it's enough or not enough, but just so that we sort of keep the baseline sort of similar. And you can kind of play in your mind with what this might look like if we change some of these numbers. But you'll see here the first couple of columns on my screen. So those who are on YouTube can see this. You'll see the scenario, the 100% equity scenario with a 10% rate of return each and every year. And it gives you a really awesome result. It gives you the opportunity to withdraw about $183,000 starting at age 65. So this is after 24 years of contributing, earning 10% per year every single year, not a down year, not an up year, always 10%. And the result is quite nice. But then what we did is we've actually taken this scenario and we've actually created a handful. So this isn't like a full Monte Carlo simulation where we're looking at every possible scenario, but we were kind of taking past historic years. Like in this first column here was like, hey, what if like we started this and it was like year one of investing, right? I put this 100,000 into the market and then 10,000 every year after that. What if I did that and it was like, it turned out to be exactly the same as being in 1926, where the S&P return was 11%. And then the next year, 37%. Then it was 43%. And then, 1929 happened, 8% down, then 25% down, then 43% down, then 8% down. So we had like 4 years in a row of down. And we kept doing this. But shockingly and surprisingly, as we scroll down here and we just follow it out, pretending like that you did this starting in 26, and we just kept going. Because we had such a long time horizon, it still ended up working out for this person fairly helpfully, right? And when I say that, it's like they ended up being able to take out $173,000. Now, if we pause there for a second, you go, wow, like you went through the quote unquote worst time in the history of being invested in the market. But here's the nuance is that we didn't have a ton of our money in there yet when it happened. It happened early, but it happened after a couple up years, and it didn't actually impact because we actually had such a long runway before we needed to take money out of this account that it was able to recover just based on some of the up years that were to follow in the 30s and so forth, in the late 40s and so forth.
So rewind there just for a sec. We invested $100,000 starting at age, what was the age again?
So this person is 40 years old.
Yep.
And he basically started this investment as if it was the beginning of 1926.
Yep. So then we did that until, and we did that for 25-ish, 24-ish years, right? And then we started pulling money at 65.
Exactly.
Got
yep.
it.
So that would have been in like 1950 if this person started pulling money. And it's like the market's been up and it's been down and it's been doing all these things. And again, we didn't mix up the numbers at all. We just took like from 1926 and then pasted them all in until age 100. And if we got this exact same replica, like so all the way to age 100 would make 1985 for this individual, like they're smooth sailing. Based on
they
what
pulled
we see
173,000 every single year during that time frame. Did not run out of money. Would run out of money maybe age 101-ish, but they got to kind of live on $173,000 if they were putting $100,000 into this particular fund. And we followed the S&P 500 from 1926 to 1985.
Yep.
So that's like that. That sounds promising. You did point out there's 3 years of up years in a row, like some good up years, and then 4 years of down. And then you're right. Like what year was it when we started withdrawing money? So it was 25 years later. After like the first 6 years, we're up and then down a bunch, and then still you have like 20 years of growth before you even start pulling any of that money.
Yeah. And I think one of these things, and I'm glad you asked it because it could have slipped by, is like one thing that really helps this particular case is that in 1949 was the last year this person put $10,000 into this account, and the return was 19%, basically. Right. The year they started taking money out was a 32% return year. So basically it's like 32% on what was almost $2 million is a massive up year, right? To start taking money from. So it's not actually hugely hindering, but imagine a world, and we'll explore this case shortly, where let's say they were about to take money out and that was a massive down year. And then all of a sudden, that one down year, if that's the year that you wanted to start pulling money out of this account, that is going to significantly impact how much you can take for the rest of your life. Right? Like, so basically it's like this person for 24 years is putting money in, and it kind of doesn't matter all that much if, you know, it's up or down or sideways or whatever it is. It's like, it's all fine. It's the year that this person took money out that's going to really dictate how much money they're going to be able to start taking out moving forward. And we're going to explore this in a couple other cases, because even in the next case, like you'll notice in this first scenario, we had 3 up years before hitting 1929, where we had 4 down years. So I thought, you know what? You know, me being the, math teacher I was thinking, you know what I'm going to do is I'm going to make those down years right away. Like, let's like really punish this person, right? They put 100 in and it's like, you lost 8% in the first year.
You picked a bad year to invest.
Yeah. And it's like, and a lot of people, what ends up happening, right, is that if this does happen, they go, ooh, I don't want to put any more money in, which is actually the opposite. They should be like, no, actually, we should be piling in more and more money here. So this person got 4 down years in a row. But you'll notice that they're able to actually withdraw more money by age 65 than they were in the previous case.
Well, they're buying low.
They're not only buying low, but John, these down years have affected less of their dollars because they happened up front. And those up years happened a little bit on the bigger amounts of money. So that actually didn't hinder here in this particular case. So like bumping the first year to 1929 actually wasn't as bad as it would be if we made 1929 the year that they wanted to start pulling money out. So I did a couple other scenarios. I picked like 1937 as a starting point. That was a 35% down year. If they started in 1937, and like, imagine you get to just play in the time machine here and like decide when you start investing this money and do this. And they did it for 24 straight years. Even though it was 35% down in the first year, they can still take out $262,000 at age 65. And when we look at this, look at that again, the year that they want to start pulling money out, what do you notice? What do you wonder? That's something we used to do with all our math students. We get a 26 and almost 27% up year in that first year that they want to pull money out. So it's almost like by chance. And again, I didn't actually set this up this way. It was like I just picked a different starting point. And it just so happens that the year that they wanted to take money out was a big up year. The next year was a very small down year. It was 8.7 down, but then it went 22 up, 16 up, 13 up before having another down year. And that has a massive impact on how much this particular individual is going to be able to take out. So again, long time horizon that they're contributing and growing it and not taking any money out. And in the years that they start taking money out, they have actually been in up years. And in these cases so far have been massive up years, which does something for the rest of their lifetime.
All right. So what I'm hearing you say so far is that even if I'm investing in my first few years or down years, that doesn't have that much of an impact on my overall portfolio growth. As long as it's, I guess the average plays out after that, which we'll typically do is we think, oh, what happens if I start investing when we were at all-time lows? Well, you're at all-time lows, which is great for maybe investing on your upward growth at that point. So I think we're saying, this rate of return in down years at the beginning, not such a big deal. Okay, now what's the next scenario you got for us?
All right. So we kept going along. I kept adding like different scenarios. This one, once again, was starting in 1964, and same thing, funding starting with 100,000, 10,000
Yep.
a year for 24 years straight. Notice the year we start pulling is 1988, 16.6% up year, followed by a 31% up year, then a 3% down year, not too bad at all, then 30% up again, 7% up again, 10% up again. It's
In the
just
90s.
like an amazing time to start pulling income for this particular individual. So I'm not going to spend much time there. We go to the next one. Again, same deal. Starting in 1970, we start pulling in. We only pull in a 1.3% up year, but then the very next year, 37, 23, 33, 28, 21. Like, look at that run that we have here. This person is like basically hit the lottery on the actual up years when they started taking income. However, I'm going to show you the last one where I intentionally went and I went, you know what, John, I don't care about when we start. I'm going to work backwards here. And I'm going to start when I want to pull money out. And I'm going to start 1929 in the 65 age year for this particular individual when they were planning to pull money out. So they're going to go 4 years in a row down. They're going to start with an 8% down, then a 25% down, then a 43% down, then an 8% down, 4 years in a row. And we're going to start pulling income and try not to run out of money by age 100. And note that we're just going to follow the sequence of return, how they happened in history, which again, will never happen again this way, right? So it still doesn't give us any certainty, but it certainly does make us go, because look at the income that this person can generate. This person can only safely pull out $69.5 million. So that's $69,500 for the rest of their life. Now, some people might say, like, based on $100,000 a year, $10,000 per year, $100,000 to start
total. To start.
And then $10,000 a year for 24 years. Like, this isn't actually all that bad.
Go back. Let's, and also I want to make sure we say it out loud for the listener who's, not watching this on YouTube. Go back to the year before we withdrew, say that year 24. So how much is in the account at that point?
We've got $2 million in the account.
Okay. Compare that to the previous scenario where this person could, based off the sequence of returns, it worked out great for them. All of a sudden they're pulling $287,000 a year and will never run out of money till age 100. Like, how much do they have in their account when they start, like the year before they start pulling?
Yeah, I love this. So they had 2.9 million in the case where, and again, and they didn't have any down years when they started pulling. Whereas
what about that first case? Like the one where it was like, we started in a bad year.
When we started in a bad year, that would have been this case here. But still turned out okay because they had 1.5, almost 1.6 million.
So it was a little closer.
But again, look at the second year they started pulling that, a 52% up year, then a 31% up year. And then when we go all the way to this, we'll call it bad case that we're looking at here. We're looking here and we go, okay, this person had 2 million to start, which is a lot, but they actually lost 8%. So that brought and took money out. So that 2 million went to 1.77 million. The next year they lost 25%. Okay, this is the 4 years in a row, 1929 to 1932. So now that 1.77 million, after taking their $69,500 of income, goes down to 1.23 million. The next year they lose 43%. That 1.3 million goes down to 684,000, and we're still needing to pull income.
Ooh. Yeah.
This is massively, massively challenging. Like, said another way, if you would have taken all this money out and put it on the sidelines, your 2 million, and you just put it on the sidelines and let it sit there, that 2 million would have gone further in the next 4 years than it has here, because we wouldn't have lost all of these
Sure.
high percentages, right?
Yeah, if you went to cash, for sure.
Exactly, which speaks to the risk that we're exposing ourselves to if we just put money in the market and we do, as you mentioned at the beginning of the episode, don't do any sort of quote unquote timing or any type of market analysis along the way.
Now, just to give everyone kind of some clarity here, where we're coming up with, say, the withdrawal amount, what Kyle has done here in each of these scenarios is, again, we're same input. We're putting $100,000 at the beginning of age 40, adding $10,000 a year into this. In the sequence of returns, he's explained this, that he's not randomizing it, but taking different points of history. But then what we're doing is, based off those returns, we're looking at how that grows and then adjusting or calculating what amount we could pull before we run out of money by age 100. So in this case, in this particular sequence of returns, we went back and recalculated how much he could pull and get away with after knowing the sequence of returns. Before the running, this is where before running out, this is where the $69,000 comes from. This is also where the $287,000 comes from in the best case scenario, where you have some great returns at the beginning and also some great returns when you start pulling your money out. We have calculated and kind of reverse engineered the amount you could pull out, knowing in history. So if you had a time machine, you could pull this money out at that time. So in this worst case scenario right now, when we have the 4 down years, we went and calculated that we would be able to pull the $69,500 out. Kyle, here's a question. Let's say I don't, obviously you don't know how much money you can pull out in the future to know that you're going to run out of money, because we don't know the sequence of returns. But let's say in this case, when you have a down year, and let's just theoretically go, you know what, it's not looking great for the next couple of years. Let's say you did not withdraw the $69,500 from those 4 years of down years. Let's say you're like, you know what, there's nothing I can do. I'm going to leave my money in the accounts. I'm not going to do what you said, go to cash. I'm going to leave it in, say, the investment account. So the 2 million is going to become 1.7. But let's say I just don't pull the 69,000 and I'm like, okay, you know what? I can go over to this thing over here and maybe I'm going to draw down on this other account that's, maybe safer. I've got, it's not, the drawdown didn't happen as much over here. Or you're borrowing something, there's a better scenario over here. I'm going to let that be. Yeah. What happens at that point?
Yeah. So I did that as you were talking, because I knew exactly where you were going there. And, I think being able to have the opportunity to go to a different bucket is really important. However, here with these 4 years in a row, it's still going to be really, really hard, we'll say, to recover. And I'm actually going to say, you know what? We're not even going to take any money out for the first up year. So I'm going to do something there.
Let it go.
And I'm going to take that out because there was a 54% return up here. And this is where we're going to get into some discussions in the next episode about cash wedges, for example, where, what we want to do is, if we are going to be exposed in the markets, especially when we're taking income from these portfolios, we want to make sure that we have the opportunity to be able to pull from other buckets. So a cash wedge of some sort during down years, because this can be massively detrimental. So here, what we've done is, instead of starting to take out at age 65, we're not going to keep contributing. So we're not contributing anymore, but we're not taking out until age 70. So that allowed 4 years down years to happen, and then a good up year to happen, and kind of buffer here. And now all of a sudden the portfolio pops back up to $1 million. And what you'll notice if we scroll all the way down to age 100 is you're going to see that if we only took 69,500 starting at age 70, what you're actually going to have is a portfolio that's grown to $13 million. Meaning, what does it mean? We get to actually take more out of this.
Let's take a little more out. Let's take them out.
Yeah. Let's see how far we can get. We can actually bump this thing up to 100, and it looks like $102,000 starting at age 70 for the rest of your life to age 100, instead of that,
massive
just a massive improvement by making that tweak. But here's the other nuance, though, is that, again, we were massively exposed by being 100% equities. And of course, those 4 down years in a row,
Sure.
you don't know if they're going to happen or not. But by being able to pull out of a different bucket, it massively changes the outcome for the remainder of your life from this particular bucket. So this sequence of returns is massively, massively important. What we're going to be doing in the next episode is we're actually going to take this a step further. We're actually going to look at how this impacts you even more if you're on some sort of FIRE quest. What we mean by that is, listen, we're looking at 100,000, 10,000 a year on top of that for 24 straight years, and seeing that there was quite a wide range of possible outcomes here. As we lower down the amount of time that we have to put into these accounts, all of these impacts, all of these factors are magnified, right? Which means it actually makes your opportunity, the window of what could happen, spread out even more so, which is really problematic if you want to set yourself up for a financial freedom early type scenario. So that's what we're going to be exploring in the next episode. We'll actually look at taking money at after age 59, after age 49. And then we'll also look at how much more might we need to contribute if I'm 40 and I only have a 9-year runway, or
Right.
if I only have a 14-year runway along the journey.
Love it. Love it. Secret sauce here for me, this last scenario outlined the exact impact you could make and save yourself without, leaving money on the table by having that extra bucket, having that extra, that extra kind of cash wedge where if I don't need to withdraw and pull down, say, that investment because I had a huge down year, then I can move to this bucket, draw down that bucket, because you saw that in that 43% down year, if I go over here and borrow, say, from my home equity line of credit that year, or if I borrow on an asset that I have, let's say I have a rental property and I go and I borrow on some of the equity on that. If I have any, say, whole life insurance policy that all of a sudden I can borrow against, then I get to utilize that and pay, say, 6, 8, maybe, in those down years, maybe the interest rates are changing to be lower, and all of a sudden I could borrow against that, and I'm only paying that much interest, and then instead of losing, those huge drawdowns and the gains. So knowing that in a downturn year, moving towards a different bucket is a great secret sauce move to avoid massive impact on your portfolio for your retirement and for long-term wealth generating using that particular fund. Switching between buckets is a great move when those downturns happen. So now knowing that downturns happen, have a massive impact, have that available bucket ready to go in case you need to pull from that. That's the secret sauce we want you to have after listening to this particular episode.